Have you ever wondered what type of life insurance is best for you? In this video, that's what we're going to continue to talk about. We've had a video series talking about the different types of life insurance and when to put them into place. And my name is Steve Larsen with Produce Freedom, and I help people find financial peace so that they can live their passion and purpose. In our last two videos, we talked about the different types of life insurance. First, we talked about putting your life insurance with a reputable company, making sure that it has the best ratings, make sure that they have the right ownership structure, make sure they're not insuring other risk besides life insurance coverage. We also talked about term coverage and the benefits and the disadvantages of term coverage and when to use those. Today, we're going to be talking about universal life insurance, which is a permanent type of insurance. And I'm going to talk about some of the benefits to that. So there are three types of universal life insurance. There's the straight universal life, there's index universal life, and variable universal life. So let's talk about those and some of the reasons why you might consider some of these. Now, this is an example, and don't get too worried about the busyness of this screen because I took some screenshots of how this works. This is a just plain vanilla universal life insurance. If you were starting one at you're 40 years old and you wanted $1 million of death benefit, you notice that the death benefit cost for $1 million is quite considerably more than the term policy that we showed in the last video, which makes sense because the life insurance companies know at some point that this is going to be paid out as long as the life insurance doesn't lapse. In the term case, they know that they're going to win most of the time. 98% of term insurance cases or policies are not paid out. And so in this case, they know that, hey, we're going to most likely have a payment, so they have to incorporate that into the payment stream. Now, one of the reasons why you would consider this is because you have a straight death benefit all the way through the end of your years. So this is your age right here and then right here. And so you know that you're going to have at least $1 million to pass to your heirs. And the way that the current IRS ruling is that the death benefit on life insurance passes to your heirs tax-free. So, and there's more that goes into that, but that's the general rule. Now, when you get into permanent insurance, they typically have part of the policy that grows in cash value. And so if you look at this is called the surrender value in this situation. So the policy is not only is it going to death benefit, but there's some type of mechanism in the background that's growing your cash value. Usually you can borrow against this or use this to pay the policy premiums or so forth. So you see this and you see how this is going and growing year after year, right? But then after about, this 30 years, it starts to decline again. And that's because universal life is built on what's called a term chassis. The expense of the life insurance portion gets more expensive with time as you age. And so it's eating into some of these cash values. So you want to make sure that models out okay for you and that the reason why you're putting this into play is for this death benefit and not so much considered on the cash value on this type of product. Now, if you're trying to leverage life insurance to grow money in a tax-free vehicle, and tax advantage would probably be a better term because if you don't structure it right, then it could become taxable, then you can use these products like an index or variable universal life policy. Now, universal life policy is still the core. It's still a term chassis. The life insurance expense is growing each year, but they keep the expenses down to like the legal minimum, and then they're trying to overfund a life insurance policy so that it goes and it grows in value. Now, the value is then not directly invested, but it's earmarked against an index or a stock, and it will grow and the cash value of a policy will increase. So this is an example, and hopefully it's not too busy. So let's talk about the index, for example. Your money's put into the universal life policy, and then as the money is earmarked into the index, if the index goes up, then your policy amount is going to go up. If it goes down, you get a floor. So here's an example. Right here, the index goes down, then it goes back up, it goes down, but then it finishes higher. So you ratchet up to this new level here. The market goes up and down again, ratchets up, and in the index model, you share some of the upside with the life insurance company, but you're protected from the downside. So if you look in this year 3 section, you have this value here, and the market tanks and drops down to here. Well, your value is still right here. on this green line. You don't go down and start over. And then the market, as it goes and increases, you still get that proportional increase. And so the nice thing about index universal life is that it gives you the ups in the market. It's not going to give you the full ups because the life insurance company are going to be participating in some of those gains. But conversely to that, you're going to have a 0% floor, so you're not going to go negative. So that can be very powerful as you plan and are trying to create some more tax advantage cash flow in retirement. Now, variable universal life insurance is a little bit different. It doesn't have these floors. So if the market goes down or up, that's what you're subject to, and that's what's happening and getting credited inside your policy. But either way, you do have a death benefit in there, but just the cash value is growing at a different rate. So when would you use these, right? So if you wanted to use a universal life policy, when you wanted some permanent insurance, but you wanted a little lower premium than whole life, and I'll show you that in the next video. And you're not as focused on the cash value growth. You're not trying to do this bank on yourself concept or anything banking, whatever you want to call it. And you don't necessarily care about a rising death benefit. You have a need, you need $1 million of coverage, universal life, okay, go. Now, if you're trying to grow your assets, right, and have it grow based on the market, or whether the index or just the individual stocks you pick in a variable life policy, then that's when you would kind of combine these into, it's a little bit more of a hybrid type product that can be very powerful. Keep in mind the index usually have a floor, and you don't get all the gains of the market. You give up some of you participate with the life insurance company, and the variable you go up and down, but there are usually some fees involved with that. So those are some things to consider when you're looking at universal life coverage. And in the next video, we're going to talk a little bit more about whole life coverage and how it compares to the other types of insurance that we've discussed so far. Now, this type of valuation, this can be very confusing, and I'm just scraping the surface here. This is all part of our continuous cash flow method to make sure you have the right type of insurance and coverages for you, because every person's situation and goals are different. And so we have our proprietary method to help you navigate through all the complexities that are out there. But I want you to know that you have options out there. You don't just have to invest in Wall Street and real estate to create a wonderful retirement. You can create more secure growth through using different types of products. So hope you join me on the next video, and we'll talk more about whole life insurance and how that can play a factor in your financial plan.